You may be wondering, how do I trade a new sensitive market? And that's why I'm here to help you. Now, as of current day, right now, it's 6/24/2025. We've had a very new sensitive market with the Israeli and Iranian, I should say, conflict that we've been seeing. The market's been very sensitive to both headlines from the Fed as well as headlines from Trump just tweeting and from Iranian and Israeli governments. We've been seeing the market react violently to these things. So you may be thinking to yourself, man, the market may be kind of hard right now. How do I navigate it? And that's why I'm here to help you navigate a new sensitive market. Now, let's start off with one thing. Let's identify what kind of person you are. What kind of trader are you? Are you an intraday trader? Are you a swing trader? Are you an investor? Starting with that mindset is going to kind of give you a better idea of how to trade a new sensitive market. Now, keep in mind, you could be all of these things at once, of course, but depending on your time frame is obviously going to affect your risk. And that's the first thing I want to talk about is how risk plays into a news sensitive market. Before you take any trades, you want to make sure in general that you're assessing your risk. What's your risk to return ratio? What are the odds of something happening when you take a trade? And as it pertains specifically when you're trading a news sensitive market, you have to understand that, especially if you're trading short-term time frames like 0 DTEs or weekly contracts, that one tweet, one news event, one something coming out at one time could kill your position like that. It could go either way, whatever can happen. So you have to take that into account when you're trading shorter term. So if you're trading shorter term, let's say you typically trade $1,000 on a trade, right? Maybe because you're only risking, let's say you trade $1,000 and you tend to have a 10% drawdown before you cut your position. So you risk a $100 loss, right? Maybe in a new sensitive market, you instead move to a $200 position and you risk a 50% drawdown. Now, why would you do that? Well, you risk the same dollar loss. You're still risking a $100 loss, but you're giving yourself more breathing room. You have a 50% drawdown there. Now, you don't even have to take that full drawdown, that full loss, but you're still allowing yourself that flexibility. Now, obviously, the limiting factor here is you'll make less money, but there are many times where you're going to want to hit the gas and hit the brakes. And in a new sensitive environment, I would challenge you to consider hitting the brakes by adjusting your dollar risk specifically to give you more breathing room. Now, keep in mind this point as well. That same $200 position, while it's not $1,000, you will make less money theoretically, but that volatility could actually work in your favor. Those news events that could kill your position like that, like I just said, can also make your position incredibly more, it could work out even better just like that, just as well. You can make more money even faster than you normally would, right? So that risk goes both ways. So because the risk is higher, the reward is also higher. So you don't have to take as much of a dollar risk in a new sensitive environment simply because of the fact that the risk of making money is higher and the risk of losing money is also higher. So you can use a smaller dollar amount and still make a big amount of money while not risking any more dollar loss than you normally would. Hopefully that makes sense. Now, specifically when we're looking at the news, you want to hunt for bearish news. And it's not because you want to be a bear. And at least this is my personal thesis. You could do whatever you want. But I like to tell people, or the phrase I like to use is a bear catalyst is a bull catalyst waiting to happen. Every single time there's something bearish that goes on in the world, it resolves bullishly. Think of it this way. Every time something bad has ever happened and the stock market has reacted negatively, what has the stock market done? Here, I'll give you a quick little, here's the SPY right now. We'll put it on the monthly chart. Take away all my doodles. What's the market done? Every time there's been anything bearish, which way does the market go? Yes, it goes down, obviously, but eventually it goes up and it goes higher because all those bear catalysts resolve. They all turn into bull catalysts eventually. Whether it's a war, a conflict, a bombing, a terroristic act, all of these things eventually resolve. Bearish headlines tend to be headlines of uncertainty. There tends to be things that the market feels questionable about. It doesn't know what's going to happen next, so there could be more of a drawback, more of a drawdown because of the fear that is in the market at that point in time and the fear that things could get worse. That is when you hunt for bull opportunity because eventually, and you can even look at the recent thing with tariffs. On the SPY, we got all the way down to 480.38. No less than 1 month later, the market hit 593.78, increase of over 100 points within a 1 month period of time. Technically 2 if you go from the beginning to the end. But you get my point here, that anytime there's high fear in the market, it will resolve. Anytime you see something bad, people bombing, killing each other, again, terroristic acts, whatever could be really bad, there will be that short-term bear catalyst. There will be bad things, especially in a news-heavy environment where there could be an active catalyst where a war going on or something like that. But once that resolves itself, you'll see a bullish reaction. Now, I want to show you a specific example that we saw as early as yesterday on the SPY. And I spoke about this earlier in the stream, but I'm going to speak about it once again here. We actually saw a decent rally on the SPY move up to the upside. Around this point in the day, around like 11-ish, we received word through news blotters and whatnot that Iran was looking to attack a U.S. airbase on Qatar. Now, we, prior days, just giving some context here, attacked Iran and dropped some bombs and trying to target some of their nuclear facilities. Now, since then, it's been a day or two, however long it may have been, the market rallied on this day. This is yesterday. And we received news at that point in time that Iran was looking to bomb this U.S. airbase. Consequently, the market sold off very bad. It sold off because the fear was there. Oh, what's going to happen next? We were just attacked, blah, 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 right? As that information resolved in real time, we saw on the day a hard push to the upside and even rally and even break and close at the high a day, because we learned that Iran told the U.S. that they were going to attack, and no U.S. lives were even lost. Effectively, and I mentioned this prior on the stream, it was the equivalent of, hey, you punched us, so we're going to punch you back, and now we're cool, right? Like, oh, you hit me, I get a free one, and now we're good. That was the equivalent of this action. So that was the resolution I'm talking about. The bear fear that you're seeing in real time on the chart here. The fear that something could get worse, or it could be more exaggerated. Think, oh, what if they drop a nuke? Whatever happens, oh, sell everything. And then the resolution of seeing, oh, it was just, you punched us, we're punching you back. Oh, okay, things are cool now. In fact, things are better than they were earlier in the day. Things are even better, because now we feel better that we're not going to get bombed again. So the market resolves even more bullishly. And that's the main thing to look for when you're looking at conflicts in general. Let's pull it back here. So as it pertains to creating a new sensitive market, I would not worry about being a bear. A lot of people find a lot of allure in being a bear, because being a bear, you typically get stronger, harder moves to the downside, and you can make a lot of money when you're correct. However, being a bear is very tactful. You have to be very timely when you're a bear. There's less flexibility when you're being a bear, and again, you're working against a few things. Keep in mind, the market statistically will always go up. Whenever there's a underperforming name, especially in the S&P 500, it will be removed from the S&P 500 and a new performing name will be plugged in. It is the top 500 performing companies. So yes, there may be periods that the top 500 performing companies lag, but they will always make more money, because even if one or two companies, three companies, four companies, however, fall out of the S&P 500, guess what? The next up-and-comers plugged in and they'll continue rallying. So don't worry about being a bear in general. I would challenge you to be more of an opportunist. Now, if you hit the bear move, God bless. There'll be times where you'll take them. I take bear moves all the time on the indexes, and I'm very peculiar when I take those moves. However, I'm more interested in being a longer-term bull because I know the wind is at my back, as I like to say. Think of it this way. Let me challenge you on something here. If you think that being a bull and being a bear are the same things, you're wrong. It's not just betting on the market going up. It's not just betting on the market going down. There's one added benefit that bulls have that bears do not. Bulls have the ability of not having margin. And obviously you can borrow on margin. But what I mean, margin to short. When you short a company, you have to borrow the stock, and you're paying money as you're shorting because you're borrowing the stock to short it. Consequently, it is more expensive to short. And you can lose more than your initial investment when you short. So the risk is also higher. So as things move up, and I'm sure a lot of you watching this will know what a short squeeze is, but as things resolve and the market moves up, there is more wind at your back, more fuel for the bulls, because shorts are going to be forced to close their short position, because not only are they upside down on their trade, but they're still borrowing money to be upside down on your trade. Imagine this. You spend $100 on a trade and you lose $150. Longs don't have to worry about that. Bulls don't have to worry about that. You spend all your money, the most you can lose is all your money. You're short, you spend all your money, you can go into debt. So there's always wind at the bull's back. Always. That's why I say don't worry about being a bear. Focus on being an opportunist and looking for those awesome risk to reward areas in the market in general when you're trading a new sensitive environment. Yesterday was a great example of that. And I did it live in our Discord exclusive trading where I had a long open on the Qs, and today it's still open. And I opened this 530 call on the Qs, which is now a 0-day option, but it was a 1 DTE for today. And I opened at 162. I believe it was 162. It is now trading at 767. And I even held it through yesterday's drama because I was very, very confident it would resolve. I opened it up somewhere around here. I held it through the bunker attack thing, and I had a very high confidence we would resolve to the upside, and we did. Now, there's other factors at play there, but the point I'm trying to make is this. I was looking for the bull opportunity. Of course, you could have made money as a bear. Of course, you could have bought puts as a bear, but the hard part is, especially about being a bear, if you're not timely, you can get wrecked pretty bad. mainly because if you see the market selling off and, oh, I'm going to flip to bear, I'm going to buy puts, and you buy puts maybe here at like 5:30 or whatever this is on the 5:26 on the Qs, and you don't close out because you think it's just going to keep going down, and in a period of 5 or 10 minutes, you're now underwater because your IV cooled and a whole other kettle of fish with options trading. Or if you're short equity, you could also have a really bad time because you don't have the opportunity to close out before it pops back to the upside. So now instead of making money, you've lost more money than you were even initially put in. So that's why I would challenge you, if you're trading a new sensitive market, to look to be an opportunist and look for those bear moves that are coming, and look for the opportunity, whether you're using technicals or other things, to keep you in the loop for being more of a bull than a bear. I would, in addition to that, look for overreactions that have solid risk to reward, because there are times like yesterday's drop where the risk to reward was very favorable in this case, and you could see in real time still that, again, these contracts are now 0-day options. They're $7, almost $8 in the money right now. The risk reward was fantastic because I had high confidence that we would be around at least 5:30 yesterday, intraday, right? We would return, and at the end of the day, we closed at 5:32.17. So fantastic. But I swung a position overnight because I had high confidence that we could see a continuation and probably some sort of resolution. I wasn't saying I'm predicting a ceasefire, but I was more or less predicting that the market would still resolve to the upside because those war fears tempered, or the expectation was met. We have a scope. We understand what is going on in the world now, and those fears will come out of the market. So I was expecting that to happen and seeing a continued upside move, and here we are today. So that's why I would really challenge you to look for those overreactions that have solid risk to reward, or it's worth taking a stab at. Like I said, $1.62 a contract, now trading at $8 essentially. Now, the last thing I'll leave you with when you're trading a new sensitive market, depending on if you're on the buy side, and this pertains to options, if you're on the buy side or the sell side, there's two different things. You want to be mindful of your premiums. So in a new sensitive environment, if you're buying at a time where there's a big bop or a big drop, you could see higher premiums. There's two schools of thought with this. If you're a buyer, you're expecting premiums, or you're expecting IV to continue to increase. So you have to be very on top of that. But I would challenge you to think on the sell side of things and look to sell contracts. Now, let's say you don't like that idea. How you can minimize the volatility risk if you're on the buy side of contracts is to look to buy contracts with more time. Unless, again, you're looking to play that IV move. So instead of buying, maybe buy a weekly contract normally, maybe buy 2 weeks out, 3 weeks out. Buy yourself a little bit more time, because those longer dated contracts are less affected by IV. Now, they're going to cost more, but they're going to de-risk you if you want to take the buy side of an options trade. Now, if you want to take the sell side of the options trade and maybe sell puts or calls, look to take a short dated contract and take advantage of that IV pop, because now that that IV is higher, people are going to be paying more money, like we just spoke about, for these options contracts. Consequently, if they're paying more money for these options contract, guess what you get as a seller? You get paid more money. So you win both ways. So I would say if you're on the buy side, look to buy more time unless you're playing an IV pop or looking for an increase in IV specifically. And if you're on the sell side of things, look to sell shorter dated contracts to take advantage of that IV, that high IV options premium that will give you a little bit more money in your coffers. And I'll leave you guys with this. In general, when you're trading new sensitive markets, you want to understand that the market is always going to fear the unknown. It's always going to feel uncertain and fear the unknown. You see a lot of bearishness come into the market when the market doesn't know what's going to happen next. When the market knows what's going to happen next, and like I said before, a bear catalyst will always resolve in a bull catalyst. It will always be waiting to happen. That's when the markets will always stabilize and rally from there. So this is how you guys can learn how to trade a new sensitive market. And if you like this video, do me a favor and drop a like and a comment down below on what you think. And don't forget to subscribe.